Picture this. You are sitting on a beach somewhere in Portugal. The sun is going down. You have a cold drink in your hand. Your rent is $300 a month. Your groceries cost almost nothing compared to back home. You did it. You actually did it. You got out. And then your phone buzzes. It is a letter forwarded by your old neighbor from the IRS. And it is not a small letter. It is not a quick question. It is a full audit notice. Back taxes, penalties, interest. Because here's the thing nobody tells you when you are scrolling through those beautiful videos about cheap living in Mexico or Thailand or Spain. The United States taxes you based on your citizenship. Not where you live. Not where you spend your time. Not which country's flag flies outside your window. Your passport. That blue passport. That is the thing that keeps the IRS connected to you forever, no matter where on this planet you choose to call home. There are exactly 2 countries on Earth that do this, too. The other one is Eritrea, a small country in East Africa that most people cannot find on a map. So congratulations, the United States is in very select company on this one. And most people who dream about retiring abroad, or who have already moved, have absolutely no idea this is how it works. They think once they leave American soil, the American tax system kind of just lets go. The hand never lets go. It just gets longer. But here's what I want you to know before we go any further, and this is the whole reason I made this video. There are fixes. Real, legal, simple fixes. Not complicated schemes, not offshore accounts in the Cayman Islands, just smart decisions, made in the right order before you get on that plane. Today I'm breaking down the 3 financial traps that are quietly bankrupting American expats right now. People who thought they had it all figured out. People who did the research, people who moved anyway, and then got hit with a tax bill in 2 currencies. And more importantly, I am giving you the simple fix for each one. Stay till the end, because the 3rd trap is the one that shocks people the most. They have been planning around completely wrong numbers for years. Number 1, the zombie state. Alright, so we have established that Uncle Sam does not stop caring about you just because you moved to Lisbon or Medellin or Chiang Mai. Before we even talk about the federal government, before we talk about the IRS, we need to talk about your old state. Because your old state, they are worse. Think about where you lived before you moved abroad. Maybe it was California, maybe it was New York, maybe it was Virginia or New Jersey or Illinois. Do you still have a driver's license from that state? Do you still have a bank account there? A storage unit? A P.O. box? Maybe a family member's address where your mail goes? A gym membership you forgot to cancel? A car registered there? If you said yes to any of those things, that state still thinks you live there. And states like California do not care that you have been physically sitting in Panama for the last 3 years. They have residency rules, and they are aggressive about enforcing them. California in particular has a reputation in the expat world for being what people call a sticky state. They fight hard to keep taxing you even after you leave. So what happens is this: you move to Barcelona, thinking life is good. You are paying a little Spanish tax, a little US federal tax. You plan for both of those. But then California decides you are still their resident. And now you are paying 13.3% state income tax on top of everything else. On income you earned while sitting in a completely different country. It is like the zombie state. You killed your life there. You moved out. You left. But it keeps coming back. Here's the good news. The fix is not complicated. It just needs to happen before you leave. Before you fly out to your new country, you move your official life, your driver's license, your car registration, your voter registration, your bank accounts to a 0 income tax state. The 2 best options in America right now, Florida and South Dakota. You do not have to actually live in these places for a long time. You just need to establish legal residency there before you leave the country. Rent a mailbox service, get a local driver's license, open a bank account, spend a night or 2 in a hotel. That is genuinely how simple this can be. You go from paying 13.3% state tax in California to 0% in Florida. That is not a rounding error. That is potentially tens of thousands of dollars a year, every single year for the rest of your life abroad. Do this before you fly out, not after. Before. The sequence matters here. Number 2, double trouble. Okay, so now you have handled your state situation. You are officially a Florida resident on paper. You are sitting in your apartment in Lisbon or Oaxaca or wherever you have chosen. You are feeling pretty good. And then someone in your expat group asks a question you have been trying not to think about. Wait, do I pay taxes on my social security here in Portugal and in the US? Like both? And everyone has a different answer. Let me give you the real one. Yes, it can happen. Paying taxes in two countries on the same income is called double taxation, and it is a very real thing that catches a lot of American retirees abroad completely off guard. Here's how it works. The US is still going to tax your social security. We will talk about exactly how much in the next section. But some countries will also want to tax that same income because you are a resident there. You are using their roads, their healthcare system, their infrastructure. They feel they are owed something. So you end up in a situation where the same check, your social security payment, all gets taxed twice. Once by the US government, once by your new home country. 2 bites out of the same apple. Here's the fix. And honestly, this is one of the most powerful tools available to American expats that barely anyone talks about in plain language. It is called a tax treaty. Think of it like a handshake deal between the United States and another country. These two governments sat down at a table and basically said, okay, let us agree on who gets to tax what, so our citizens do not get hit twice. Take Portugal as an example, one of the most popular retirement destinations for Americans right now. Under the agreement between the US and Portugal, your social security is taxed by the United States. Portugal leaves it alone. You are not paying both. Just one. Now compare that to a country with no tax treaty in place. Suddenly both governments want their cut, the paperwork is a nightmare, and you are scrambling every April. This is why choosing your destination country is not just about weather and cost of living. The tax treaty status of that country is a financial decision that will affect you every single month for the rest of your retirement. Portugal, Germany, France, Italy, Spain, Mexico, these countries have the handshake deal. You are protected. Thailand, Panama, Costa Rica, Vietnam, Belize, no treaty. You are on your own. Before you fall in love with a place, check the treaty list. It is the difference between a comfortable retirement and a tax headache you are dealing with every single April for the next 20 years. Trap number 3, the 85% surprise. Alright, we are at the third trap. And I want to warn you right now, this is the one that hits people the hardest. Not because it is the most complicated, it is actually pretty simple math, but because people have been operating on completely wrong assumptions for years, sometimes decades. And when they find out the truth, it stings. I've talked to retirees who have already moved abroad, who have already built their whole budget around a number, and that number is wrong. Not a little wrong, fundamentally wrong. Here is what a lot of people believe. They say, I paid into Social Security my whole working life. That money was already taxed. So when I get it back in retirement, it is mine. Tax-free. That is not how it works. And moving abroad does not change this one bit. The IRS uses something called your combined income to figure out how much of your Social Security is taxable. Combined income is basically everything coming in, your pension, your investment income, plus half of your Social Security benefits added together. And here is where the numbers get uncomfortable. If your combined income goes above $25,000 as a single filer, the IRS can tax up to 85% of your Social Security benefits. For married couples filing jointly, that number is $32,000. Let me put that in real terms. Let us say you are single. You get $2,000 a month from Social Security. That is $24,000 a year. You also have a small pension, maybe a bit of investment income. Together, your combined income comes out to around $35,000. You are over the threshold. The IRS can now tax up to 85% of that Social Security check. And again, living in another country does not erase this calculation. The math does not care about your time zone. Now here's the silver lining buried inside this trap, and this is why the whole moving abroad thing, done right, still makes so much sense. You probably cannot stop this tax. Once you are above those income thresholds, the math is what it is. The IRS is going to take their portion. You're not going to outsmart that with some clever filing trick. But you can move to a place where what is left buys you a completely different life. Think about it this way. Let us say after everything, federal tax, whatever your new country takes, let us say you are walking away with $1,400 a month. That is your real number. That is what hits your bank account. In a mid-sized American city, $1,400 a month is a crisis. That barely covers rent in most places. You are stressed, you are cutting corners, you are watching every single dollar. In Medellin, Colombia, that $1,400 covers a nice apartment in a good neighborhood, groceries, nights out, and still has money left over. In Chiang Mai, Thailand, same story. In Tbilisi, Georgia, people are living remarkably well on that number. This is the core calculation that changes everything. It is not about how do I avoid taxes. That ship has largely sailed. The real question is on where does my after-tax dollar go the furthest? And the answer is almost never the United States. So when you are choosing your destination, you need to be running two calculations side by side. First, what does the tax situation look like in this country, including treaty status? Second, what does my after-tax income actually buy me here? The countries that win on both of those, no local tax on foreign income, plus an affordable cost of living, those are your sweet spots, and there are more of them than you think. The bridge. Information versus execution. Okay, let us take a breath for a second and talk about where you are right now. You now know things that most people planning to move abroad do not know. You know the IRS is still watching, regardless of what country you call home. You know you need to handle the zombie state situation and move your official residency before you fly. You know you should only pick countries that have a real tax treaty with the United States. And you know that the 85% rule on Social Security is real, it follows you across every border, and your defense against it is not a tax loophole. It is a lower cost of living. That is real valuable knowledge. That is more than most people figure out before they make this move. But here's the problem. Knowing the tax strategy and actually executing the physical move are two completely different things. And a lot of people who have the tax part figured out stumble completely on the logistics. You cannot just pack your bags and hop on a plane. Well, you can. But then what? You land in your new country and realize you do not have a bank account set up there. And moving money internationally is not as simple as a quick wire transfer. There are fees, there are reporting requirements, there are right ways and wrong ways to do it. You show up with a tourist visa and then discover the visa category you actually need, the one that lets you stay long-term, rent an apartment, access the local healthcare system. That visa requires documents. And those documents need to be in a specific order. And some of them need to be officially certified, which can take weeks if you do not know what you are doing. You find the perfect apartment and then realize you cannot open a local bank account without proof of address, and you cannot get proof of address without a bank account. That catch-22 is real, and it trips people up all the time. I have seen people who spent years dreaming about this move, who did all the research on taxes and costs, and then they got tripped up on paperwork, on a document they did not know they needed, on a bank that would not accept their application because they did not bring the right form. The tax strategy means nothing if you cannot get to the country legally and set up your financial life correctly once you are there. That is why I made a separate video, and I want you to go watch it right after this one. It is called the Exit Plan. It breaks down the exact step-by-step checklist for the physical move itself, the visa sequence, the international banking setup, how to move your money without triggering unnecessary reporting headaches, the healthcare registration process, the address catch-22 and how to solve it, the specific paperwork sequence that makes your arrival as clean and stress-free as possible. The tax strategy you learned today is the financial foundation. The exit plan is the execution layer on top of it. You need both. Click the card in the corner or find the link in the description. If you are serious about making this move and doing it right, that is your next watch. I want to end with something that gets lost in all the tax talk. This dream, the beach, the low rent, the slow mornings with good coffee in a place that costs a fraction of what home does, it is real. It is not a fantasy. There are hundreds of thousands of Americans living this life right now. Real people, not just influencers, not just people with giant investment portfolios, regular retirees, teachers, former middle managers, people who saved steadily their whole working life and just wanted their retirement dollar to actually mean something. And they made it work, not because they found some secret loophole, not because they outsmarted the government, but because they did the planning. They checked the treaty country list. They handled their state situation before they left. They picked a place where their after-tax income meant something, and they followed a checklist that made the actual move clean and simple. That is what this is all about, not tax avoidance. not some complicated offshore scheme. Just smart, legal, well-sequenced decisions that let you live a better life on the income you already have. The IRS is not going to disappear from your life. That is just the reality of being an American citizen. But they do not have to ruin your retirement either. You just have to be smarter than the trap. If this video helped you, hit the like button. It genuinely helps more people in your exact situation find this content. And drop a comment below. Tell me, which of these 3 traps surprised you the most? Was it the zombie state, the double taxation risk, or the 85% rule on Social Security that you had not fully accounted for? I read every comment. Your questions are literally how I decide what to make next. And if you have not subscribed yet, we do this kind of breakdown every week. Real information for people who are actually thinking about this move or who have already made it and want to make sure they are doing it right. Hit subscribe so you do not miss the next one. I will see you in the exit plan video.